Rainy day here in Chicago. It's a good day to learn something about markets, I suppose. So let's begin. I've got a lot here. I'm going to go through a lot of it quickly. So there's a PDF, as Trey mentioned. So you can circle back. You can grab the PDF, or if you forget to do that, you can contact us and you can get the the PDF. So we're going to show you kind of our unique approach to investing. And I'll try to save a little time for a few questions at the end. So just a little background about me. This is my 43rd year in the business. I started out as a runner on the Chicago Mercantile Exchange, 1980, green as grass. I didn't know anything about the markets. And I fell in love with it almost immediately. I spent I guess about 17 years there. I think I left the floor in 1997. I worked for a lot of big firms, Shearson, American Express back in the day, and NatWest Markets and Deutsche Bank. I launched Asbury Research in 2005 for professional and also individual investors. I'm now a contributor to Forbes, StockCharts.com, Investors Business Daily, American Association of Individual Investors. So I've been around the block a few times, and it's nice to be seen. I mentioned about the slides via the PDF. If you like our approach to investing and markets, you can visit asburyresearch.com and use the contact tab there to request more information about our services for investors. And we also have a YouTube channel, Asbury Research YouTube channel. There's a lot of free information there. There's a lot of videos. My oldest son works with me, and he's got some videos there as well. What we do, we utilize a fact-based, data-driven approach that just follows the money around the financial markets rather than trying to predict the future. Our focus, as you can tell, I'm not 30. Our focus is on wealth preservation with growth. Most of my clients tend to be of my generation. I think most guys that I know who do what I do for a living, they tend to attract people from around their age. So we have some young folks too. We don't do any crypto here, but it's basically based on how to play the game with less risk, or how to play the game with similar risk to the S&P 500, but with better returns. Our models really simplify things. When it's allergy season in Chicago. When I started in the business, if you wanted to get quoted in the journal, if you wanted to get asked on CNBC, you had to have a nice suit and you had to have a outlandish forecast, and that's how you got on. Now that I've been doing this a long time, I've learned that I can't see the future. That's the bad news. The good news is nobody else can either. So what we do is a lot of back testing. We do a lot of quantitative back testing of our models and ideas to show us what has happened using certain methodologies over the past 5 to 7 years, which is kind of the sweet spot that many market watchers, including Ray Dalio, focus on that 5 to 7 year period and don't say, well, this worked really good in 1990, because it's not 1990 anymore. And then we try to project those forward rather than trying to come, to tell you where I think the market's going to be or who's going to win the election. That's show business. It's not the financial business. So that's how we're a little bit different. Our models tell you when it's time to be aggressive and fully invested. We call that risk on. When it's time to be defensive and protecting your capital, which is risk off to us. And then we look for sectors and industry groups to buy that are outperforming. Relative outperformance is a huge part of this game because, as we all know, the market goes up over time. The game changes when you get into your middle to late 50s, the game changes. The metaphor that I use is it's like football. In the first half, in the first 3 quarters even, you can do trick plays. You can throw some bombs. You can do some risky plays because you've got the rest of the game in front of you. In the fourth quarter, though, if you've got a lead, you don't see any bombs anymore. You don't see many flea flickers or handoffs. You see the fullback or the halfback has the ball. He wants to protect and he's holding on to it tight. Nothing goes in the air. He wants to protect what he has. Most of my clients, I'm in my 60s, are in the fourth quarter of their investing lives. So you don't want to make any mistakes. So we're kind of geared towards that. We don't do a lot of high risk stuff. We want to play the game with less risk. Data-driven models. We'll go through these. We've got the correction protection model for wealth preservation. Some of you might be familiar with that. That's our first model. I think that's the first model Jack and I built, probably going on 12 or 15 years ago. We've revamped it to bring it up to the times, change in interest rate policy and other changes during that time. Our Asbury 6 model is really a risk management indicator. Our SEAF model, sector ETF asset flows model, is for sector selection. CARP model, the CA in CARP stands for cross asset. That's for domestic asset allocation. In other words, after you're in the market, where should I be? What parts of the market should I be in so I can ideally outperform the S&P by a little bit? Being in the S&P while it goes up 10% is great. Being in outperforming markets, so the S&P is up 10 and you're up 13, that's nirvana for us. We spent a lot of time trying to do that. And then finally, we've got our US versus the world model for global asset allocation. Next slide is, I like to go back to the last time I saw you, last time I was with you, say, this is what we said then, here's what happened, and it gives us kind of a moving starting point. So when I'm back with you in 6 months again, in January of next year, I'll look over what we spoke of today, and I'll put another slide like this together. So back when I was with you on Jan the 11th, I had said that the S&P 500 was at an important inflection point from which the next 1 to several month directional move up or down was likely to begin. Right then, it was hard to tell. There was a lot of internal weakness showing up at the market. I added that I would view a significant decline in underlying support as a potential new buying opportunity. We never got that move down that I was looking to buy a correction, but artificial intelligence-related stocks quickly took over the market. There was a big symposium in Las Vegas on August the 8th and 9th, where firms like NVIDIA and others announced new AI improvements, technologies to wrap around their products. And the benchmark S&P 500 got up above 4,200 resistance, which was a big barrier at the time for the market. It was a previous high. Subsequently rose by an additional 14% to 55.24. We're now at 55.99. We're just about at 5,600 as I look at my screens. Microsoft. I said Microsoft was struggling to hold its November 10th breakout higher above 367, and that this was a strategic decision point for the market, for this market leading stock. Microsoft actually held 367 support in the upcoming weeks and then rose by an additional 19%, probably 20 or 21% now, to its all-time high. As again, this AI-driven rally really grabbed those mastodon tech stocks like Microsoft and NVIDIA. Amazon was in there, others that we'll talk about. Correction protection model. We said CPM was on a November 3rd risk on status. That was November 3rd of last year. CPM has remained risk on with the exception of about 2 to 3 weeks during the middle part of April, while the S&P has risen by about 28 to 30%. So CPM is still risk on. We'll take a look at that a little bit closer. I like to give the answers first, and then we go through the slides. Here's what we're seeing. Here's how we're interpreting the data that we think is important. The market's overextended historically, according to price momentum and investor sentiments, but most of our tactical, and if you hear me talk about tactical during the presentation today, tactical for us is 21 business days or a business month. Tactical is how we move in and out of that larger trend that we're trying to capture. That larger trend for us is what we call strategic, and that is quarterly or more. If it's 2 quarters, better. If it's 3 quarters, it's even better yet. But we're using tactical tools to try to move us in and out of strategic trends. Almost all of our tactical and strategic metrics are still positive, still bullish. Tactically, support in the S&P 500 is about 4% below the market. We're going to look at that specifically in just a couple of minutes. Amid a positive Asbury 6 and a risk-on status in our CPM model, correction protection model, as I mentioned, effectively since November of last year. Strategically, we've got unmet upside targets in the Dow Industrials and in mega cap artificial intelligence bellwether Amazon. That's another one of those big stocks that I talked about. They suggest a potential for an additional 6 to 7% move higher in the overall market before this uptrend runs its course. Note that the seasonal trend turns decidedly negative in August and September, actually towards the latter part of July. We'll look at that a little closer. Size and style. Size is small, medium, and large. Style is growth or value. Since late May, S&P large cap has significantly outperformed the S&P 1500. The large cap is the 500, and the 1500 is the 4, the 5, and the 600, all looked at together as a group, while growth, right around that May 23rd time, we'll look at this a little closer too, has significantly outperformed value and the S&P 500. So we'll look at those in more detail. Domestic allocation, that is the CART model for us. Our CART model has been on a risk-on alignment for the past 7 weeks, most recently with 5 offensive and just 1 defensive relative relationship. We'll look at this closer. This suggests investors are confident right now that the U.S. stock market can keep rising from current all-time highs. Global relative performance. Just 3 of the 25 global equity indexes that are represented by our U.S. versus the world model, Taiwan, South Korea, and India, are outperforming the S&P 500 on a tactical and on a strategic basis. Taiwan and South Korea are directly related to this year's AI explosion, either in technology or in hardware. South Korea makes a lot of the hardware that is used in AI. So that was really interesting to me. 3 out of 25. And they're all AI related, just like most of this rally that we've really had since the middle part of January has been driven by those stocks, NVIDIA and Microsoft and Amazon and others. That same 5 or 6 stocks, they're so big. I think that top 5 or 6 stocks in market cap in the S&P 500, which are all AI related, are about a third of the total market cap in the S&P 500. So they're extremely influential. U.S. interest rates, we're going to look just a little bit at the end. I know everybody wants to know about rates. Rates are basically locked, according to the yield of the 10-year. They're locked in between 5 to 5.23% up on top. 5% is a big psychological area. Underneath, 431 to 425 is what I'd call an intermediate term yield support for the 10-year. We're right there right now. We either hold this 430-ish area and move back towards 5%, or if it breaks, a sustained decline below 425 would take us to 4%. So again, there's a lot of consternation about rates. There's a lot of consternation going on with the presidential race and what that's going to do to the economy and inflation. So I don't try to forecast who's going to win the election, what the Fed's going to do. What did Powell have for lunch today? I don't care. All I'm doing is watching the data. The data that we look at, and we're totally data-driven here, there's little to no opinion, is what the collective wisdom of all the people and companies that have skin in the game, they have money in the market, what they think as a huge group. To me, that's the smartest guy in the room, is all that money. And what I think of something, even though I've been doing this for a long time, I want to know what the room's thinking and not what John's thinking. Let's look at some charts. Price and trend. Market leading tech and semis are setting all-time highs. During a healthy bull market, most of the time, there are no all the times in the stock market, you're going to get leadership from semis and or technology. This is the SOX index, the Phillips Semiconductor Index. It took out its January 2022 high right around Christmas time last year, ran up to the March 8th high, came back, retested that breakout on April 19th. It's making fresh highs. Tactical support here is around 5,200. That's 10% below the market. So that is normal bull market behavior. This is the comp. This is the NASDAQ Composite Index, which is the broader of the two NASDAQs, along with its 52-week moving average in orange and 13-week, which is a quarter, in blue. Most of these charts, going back to the daily really quick, you're going to see me use two interest rates, or I'm sorry, two moving averages to kind of apply a skeleton to these charts so we can see what the trend is. On a daily chart, the 200 days, the major trend, the 50 days, the minor trend. On a weekly chart, I'm looking at a 52-week, which is 1 year and a rough equivalent of a 200-day moving average. And then the 13-week is the quarterly trend, which a lot of managers manage their books to the quarter. So the comp took out its November 2021 high, similar to the Jan 22 high in SOX on March 22nd, and is setting all-time highs. So that answers the question, is there leadership? Yes. What the chart doesn't show you is that leadership is real thin. There's 5 or 6 mastodon mega cap AI stocks that are driving the bus, but you're getting leadership from tech. This is the Russell. This is small cap. This is weekly, 52-week moving average, of course, here in orange, as I stated. Since we broke out of these April 2018 and January 2020 highs from the COVID lows down here in March of 2020, we made a streaked up to a peak in the latter part of 2021, but for the past 2 years, we've been ping-ponging back and forth between 2030 and this big support level down here from 1742 to 1641. So I have financial TV on all day. It's the buzz in my ear that I used to get when I was on the trading floor for 17 years. I want to hear the buzz. I want to hear what people are thinking, what people are saying. I'm hearing a lot of people coming out and talking about the Russell. We have to look at small cap. No, we don't. It hasn't been doing anything for a couple of years. If this breaks out, I'm interested. If it doesn't, there are other places to play. This chart here is the Dow weekly, excuse me, with its 52-week moving average, going back to very late 2019. Takeaway here is from the COVID low in March of 2020 to the January 2021 high, it's coiled sideways. When markets coil sideways, it means that they're in a period of indecision and trying to digest this monstrosity of a move from 18,000 to 38,000 that it had in 20 and 21. It broke out of that indecision on DC1 of last year. Why does that matter? Because it indicates that the market has decided that this bigger March 2020 trend is still valid and it's starting to resume. The target on this is 41,500. That's another 6% higher than where we are right now. When would that not be true anymore? If we reversed and took out, let's call it 37,000, which is a 52-week moving average. So the Dow is telling us that there still might be some gas in the tank. This is price and trend 3. This chart is a staple in all of our research, our weekly wrap-up report, which comes out on Sunday before the opening on Monday, and also our Keys to This Week report, which is a weekly 10 most important charts and data series to watch in the S&P. They're always in both of these reports because this is kind of the game board. I call it the game board, right? So we're in an uptrend, right? We're above the 50, we're above the 200-day moving average, we're in major uptrends. When is the minor trend, which is up, turn to down? If we break down through 53.57 to 53.31, that's how to answer that question right now. That's about 4% below the market. As I stated in the opening, that's the trend line from October 2023 and the 50-day moving average, which are kind of converging here at 53.57 to 53.31. If we break there, we got another 8 to 9% to go on the downside before we hit major support, which is at 49.50 to 48.99. That's the April 19th benchmark low and the 200-day moving average. What does that mean? If we get a correction here between now and the election and we break down through this tactical support, we could theoretically drop another 9% and go down to our major support level and still be in a major uptrend. That's when guys like me that have been doing this all their lives start licking their chops. Because if we can avoid between here and here, or even part of it, and then reapply that money down here, that's when you can cover a lot of territory in a relatively short period of time. For older investors, being able to avoid the major part of a downside move and then reapply that money lower at better prices, it's as good as it gets. Our CPM model tells us when to go risk off. When that happens, especially if we've broken down through support, whatever that may be, when the CPM goes to risk off, that's when our game plan changes. That's when we start pulling assets out of the market, maybe moving them into some kind of an interest-bearing account and wait for the sun to come out again where we can buy at better prices. Relative performance. To me, relative performance is at least as important as outright price. I know that sounds not logical, but after doing this for a long time, the longer I do this, the more I realize how important that is. This is XSD up here. This is one of the ETFs that tracks the Philex Semiconductor Index. Note that it started outperforming SPY down here in the lower panel on a 63-day basis. Why 63? That's Asbury Research's strategic time period. It's a business quarter. Started outperforming SPY on April 26th. Had a little retest of that 63-day moving average on a relative basis down here at the end of June. Look what happened here. That was another tactical bottom, let's call it, in XSD, and we're off to the races. Relative outperformance by semis and tech is, in my view, imperative components to a sustainable uptrend in the overall market. This is NDX now here on the right. This is a daily chart going back to Q4 of last year, and we're measuring NDX on a relative basis versus SPY. You remember, NDX is the NASDAQ 100. That's the largest 100 NASDAQ stocks according to market cap. Look what happened here. On May 16th, it started outperforming the S&P 500 SPY on a quarterly basis by going through the 63-day moving average. That was right about here, right after we had this little minor low in April. And then on June 14th, it set a new all-time relative high versus SPY. That's bullish. Now, granted, this just may be 5 stocks that are making this happen, but it's happening. Would I like it to see 50 stocks instead of 5 and have better market breadth? Yeah, but you don't always get to play football on a sunny day with a dry field. Both of these are telling us that the market is still healthy enough to continue higher. Relative performance 2, IWM is the iShares ETF version of the Russell 2000. Again, when I hear on financial television that the Russell is up today and what about small cap, I twitch, because look at this. IWM has been underperforming SPY since January 16th. It's underperformed by 10%. Has it gone up? Maybe a little bit, but why would you want to be in this part of the market that's underperformed by 10% when you could be in semis or tech, which have outperformed by the same amount? The swing there is 20%. From being in IWM to being in NDX, that relative swing versus SPY is 20%. That's huge. So knowing where to be and not just what the direction of the market is imperative for smart investing. This chart here, this is the NYSE composite index. To me, it's a cousin of the Dow. They're both defensive, higher quality stocks. When the market is risk on and the investors are looking to add risk, this is not a place they want to be. And you see that from February of 2023, almost 18 months ago, NYSE has underperformed the SPY by 16%. What does that tell me as an investor? Well, number one, not to buy NYSE, but bigger picture, this is what happens in a healthy bull market. People move off of the burrows, which I would call this and the Dow 30, the sure-footed burrows, and they go into the racehorses, the thoroughbreds, which are semiconductors and the NASDAQ. So all of these relative relationships right now are what you see or what you would like to see if you're in a healthy, again, market breadth aside, a healthy market environment. Key stocks to watch. Apple. Apple streaked up to the July high here in 2023, then drifted sideways for a year. It broke out on June the 11th because, and I actually have this queued up on another computer, is there was Apple's Worldwide Developers Conference. The keynote with Tim Cook was on the 10th, I believe. Worldwide Developers Conference keynote. And then from there, Apple came out, announced iOS 18, its latest operating system with the update available in the fall. And they also talked about Apple Intelligence. Apple unveiled Apple Intelligence personal intelligence system to use AI. All of this. So we had a breakout in Apple from a year ago and sideways on June the 11th. That targeted a move to 230. 230 was, if it hasn't been met today, it was met yesterday. Oftentimes when you hit our target, so we put this out to clients as a breakout on June the 11th, said 230 was where we were going next according to this chart. It hit that target. That was a 14% advance from here to here. What does that mean? Oftentimes, I'm not the only guy on the planet that knows how to read charts. So there might be a lot of people that bought during that conference, July 11, July 12, July 13, that said, hey, I just made 14% in about a month. I'm ringing the cash register. I'm taking the money and going somewhere else. We may see a little pullback here. Now, note the same thing happened in Microsoft. Microsoft, the chart looks different. The pattern looks different, but the message is the same. From September of last year through March of this year, started moving sideways, more investor indecision. We had breakout that same day. That targeted a 9% move to 473. 473 is either just missed it or we've already exceeded it. The S&P, the NASDAQ is up 135 points today. We could see a little pullback in these stocks because this made 9% in that month. But so some of these near-term targets are starting to get met. That was the message of this slide. This slide, this is Amazon, which is, again, part of that. It's an AI stock. Amazon had been bumping against its July 2021 benchmark high of 188.65 since April. It broke out on June the 26th. The breakout indicates that this larger move is resuming. Targets a move to 213. 213 is 7% higher than where we are right now. So I showed you the pattern in the Dow, that longer term pattern that says we got another 6% to go before we hit 41,500. This is a shorter term pattern that says 7% higher for Amazon. When does that go away? What would change my outlook? If we break down through the old high that we made in July of 2021 and the top of this indecision pattern, which is roughly $189 a share. So the last one, I had to look at NVIDIA, right? Because that's the show this year. That's the star. NVIDIA's been drifting sideways since June. It's up, what's it up? 100% or something for the year. You know, when it broke out in the second week. Actually, NVIDIA broke out the second week of January after the symposium that we had on Jan 8th, Jan 9th in Las Vegas that talked about new AI technologies that were going to revolutionize the world. But this pattern here, it's drifting a little bit. If NVIDIA breaks down and goes through 119 from here without touching or without going higher than its June 20th high, it would suggest a tactical top here and that we could have a move down to 97.40, which is pretty good support down here, which is a big move. So if you're in an NVIDIA, or if you're using it as I am as a bellwether for the AI-driven stocks, above 19, good. Below 119 is bad. Watch 119 a share in NVIDIA. Here's our CPM model. Oldest model after the financial crisis, the financial crisis in 07, 08, and then the subsequent huge rally that we had in 08 off of the lows. Excuse me. I had a lot of our wealth manager clients ask if we could build a model that was real simple, risk on or risk off. It didn't trade very much, but it helped those people maybe to get out of the stock market, or at least get out part of their holdings in the stock market during the financial collapse, and then be able to have the guts to put those longs back on after the bottom was formed. So we built CPM, designed to protect investor assets during a market decline. It's a wealth preservation tool. Again, to play the game with less risk, completely data driven. It's binary. It's either risk on or risk off. When the market's uncertain, there is more movement. When the market becomes certain again, here's November 2nd. That's our signal, November 2nd. It became actionable on November 3rd. Took us all the way up to the April 15th high, got us out for a couple of weeks and got us right back in on May 3rd. We are risk on. It averages about 5 round turns a year. It's about once a quarter, a hair more than once a quarter. We don't do any short positions, don't do any futures, derivatives. Annualized total return is very comparable to the S&P, but with significantly lower risk, according to standard deviation, beta, maximum drawdown. By the way, if you don't know what these terms are, go to Investopedia. I don't have any relationship with them other than it's the best place I've found on the internet to learn what all of these financial jargony terms are. CPM is better risk-adjusted returns in the S&P, and we have been able to turn it into an alpha generation model by using some leverage there. I'm not going to talk about that here, and I don't suggest anybody that I don't know to use leverage. It's very risky, but let's look at what I'm talking about here. So this is since Q4 of 2017. It's basically been a relative performer versus the S&P 500. You can see the total return through the end of last year, and we're about equal this year. We're right with the S&P this year, but through last year, S&P annualized total return was 10.5. CPM using SPY to trade at risk on and risk off was 10.8. But the maximum drawdown in the S&P was 34%. In CPM, it was 20. It was 40% less. Risk, standard deviation, 17.7 in the S&P versus 12.4 in CPM. And the beta is 1. That's a standard for beta in the S&P. It was 0.59%. Again, about 40% less. This is what the chart looks like since then, CPM via SPY and SPX. You can see it sticks to it like glue, and it gains on it during these big drawdowns. Like this is the COVID drawdown. It got out of there about halfway through and was able to go back to risk on with a nice lead off from where the S&P was. We did the same thing in October of 2022. We avoided that last surge down in the S&P that broke the 200-day moving average, scared the heck out of everybody, and it gave us a nice lead off going into the next move higher. This is yearly from 2018. PDF's available so you could look at this closer. Our Asbury 6, I built the Asbury 6 10-ish years ago. We kept it in-house for several years because even for a guy that's been doing this all my life, I was getting faked out by the S&P 500. I would be bullish. All of our work would be bullish. And I come into work on Monday morning and the S&P's down 60. The next day I come in, the S&P's down another 30. So, I'm going through my charts. What did I miss? What happened? Take some of your position off because you start making emotional decisions. Well, what happens? 4 days later, the S&P 500 is making fresh highs, and I've got to put those longs back on at a worse price. And I've and me, the big market expert, has gotten faked out. I'm sure you've all gone through that. So I built this model to look at 6 disparate ways to judge the internal, under the hood, if you will, health of the stock market with tools that aren't affected by the daily gyrations of the S&P 500. There are 6. We look at the rate of change in the S&P. We look at relative performance of stocks versus high yield bonds. We look at investor asset flows, volatility, trading volume, and market breadth. Excuse me. Right now, they're all green. They're all positive. Look at what positive as of. Most of these have turned positive either in late June or the day before the 4th of July. Here's one here, trading volume. Let's look at them individually. This is the first one. This is a monthly rate of change in the S&P 500. It rose above its 21-day moving average, again, our tactical time period, on June 28th to indicate a positive reading. But look how close it is to that 21-day moving average. What does that mean? It means we could have a couple of bad days. Like I said, CPI is Thursday. Inflation, a huge inflation gauge. PPI is on Friday. Another not so important, but still pretty significant way to judge inflation at the producer level. So this is bullish, but just barely. Relative performance between SPY and junk, which is the S&P 500 versus the Bloomberg Barclays High Yield Bond Index, JNK. On May 6th, SPY started outperforming junk on a 21-day tactical basis. Look what the market's done. This is solidly positive, solidly in positive territory. ETF asset flows. We look at the total net assets, or the AUM, going into SPY. From May 6th to June 17th, it was expanding on a monthly basis. That gave us all of this in the S&P. But look what's been happening since then. Drooped underneath there during the middle to latter part of June. On June 25th, it came right back. But all it would take is a couple of bad days to push these assets back down through the 21-day moving average. Now, 2 of those 6 could be red in the A6, in the Asbury 6. Volatility, according to the VIX. Look how flat this has been. We're stuck right around 12. And since June the 25th, it's leaned towards investor complacency, which is tactically positive. But look, all it would take is the smallest shock to the market to push VIX back up above its 21-day moving average in black here. Now you've got 3 of that Asbury 6 flashing a warning signal. Volume. We use cumulative volume. The NYC cumulative volume index is the one that we use for this particular model. Look what's happened here. It's moved back above its 21-day moving average. Volume indicates urgency to buy, but just barely. We could have a bad day or 2 here and be back below the 21-day moving average. That would make 4 of the Asbury 6 have turned red. 4 of 6, 4 or more in either direction indicates a directional bias. You can go to our website, asburyresearch.com, and go to models, and you'll see more details on this, on CPM and on CEF, which we're going to get to. But the point is the same. We could have a couple of bad days based on CPM, and all of our tactical stuff starts to turn negative. So be on your toes. Here's market breadth. We did this on, we made this chart on the 9th, which was yesterday, looking for signals as of the 8th. So as of the 8th, the AD line in the NYSE, which is a market breadth indicator, edged into positive territory. But it's been flat as a pancake since June. It actually dropped into negative territory as of yesterday. So tactical decision point. The CPM could, the Asbury 6 could very well turn negative over the next couple of days unless things are hunky-dory with CPI and PPI on Thursday and Friday. The CPM is different. The CPM is built to keep you in the trend as long as possible, but to avoid the major drawdown. So theoretically, we can go negative on the A6, have a week or 2, and the CPM still keeps us in the market. That's what it's for. Here's other indicators that I'm looking at. I'm going to burn through some of these because we're running out of time. Another way to look at ETF asset flows is because technology is leading the charge this week. I want to know what the Invesco QQQ asset flows are doing. Note that they have been on a trend of monthly expansion since May the 3rd, right here. And NDX is up 14% since then. Note that there was a couple of tests of that here on June 4th. That was a tactical bottom here. And on June 24th, that was another little tactical bottom here. If this turns negative and stays there, that means we've got monthly contraction, getting smaller in those assets, and that will be a tactical kind of a kiss of death for the market. So we watch this every day, along with these ETF asset flows and about 100 other ETFs. It's a big part of our work. Standard deviation, near-term positive. S&P 500 on top, and the percentage of NYSE stocks trading 2 standard deviations above their 40-day moving average down here in the lower part of the chart. Note that, and this speaks to market breadth, we're down at these low levels of only 3% that we had on April 18th, which was a tactical bottom. Jan 17th, another tactical bottom. October 2023, more important bottom. August of 23, a minor bottom. This is near-term positive for the market on a tactical basis. This is an intermediate-term metric, relative performance versus SPY versus AG. What's AG? It's the iShares Core US Aggregate Bond ETF. Note that when stocks are outperforming bonds on a quarterly basis, why quarterly? Because this tells us what the strategic trend is. That trend changed on November 3rd. November 3rd, for totally different reasons, was also when our CPM went back to risk on. Look what's happened here. It's tested it a couple of times. December 5th was a little one here. Tested the 63-day moving average of SPY outperforming AG. Tested it on April 19th, tactical bottom. Tested it again on May 1st. And we've got a lot of real estate here between the indicator and its 63-day moving average. So this is solidly intermediate term positive for the market according to relative performance. This is overbought, oversold. I'm going to go through some of these quickly. We're overbought on a monthly basis in the S&P 500, but in a bull market, it really doesn't matter. This is just, I look at the same things all the time, kind of like swinging the club the same way if you're a golfer. This right now is kind of irrelevant. What's more relevant is on a quarterly basis, the S&P is about as overbought as it's been going back to late 2018. Most of these led into some kind of a 1 to several month top. Is this an indication to sell? Absolutely not. It's an environmental indicator to kind of tell us where we are in the spectrum of this trend that started to move higher in October of 2023. It's technically vulnerable to a move down. When does it become actionable? When the A6 turns 4 or more red to tell us the internal health of the market's breaking down. And finally, when CPM tells us from a risk standpoint, it's time to start to protect assets. We're not there yet. Investor sentiment, too bullish, according to a survey of near to intermediate term futures traders, which is usually when you see some kind of a near to intermediate term peak. Again, not signal to sell, environmental indicator like the last slide. This is the II data, the Investors Intelligence data, survey of intermediate to long-term. They're not really newsletter writers anymore. They're companies like Asbury. We're independent research providers. Right now, that group that they survey, only 14 to 16% of them is bearish. In the past, when that's happened, you can see it's been maybe a week, maybe a month or so in front of, you could argue, the most important peaks that we've had here going all the way back to 2010. Not actionable, but it's telling you that the next time that we get a move to negative in the Asbury 6 or a move to risk off in the CPM, it could be a bigger signal than you would normally expect. seasonally. We get a little bounce here, a little kind of relief rally here in July, but then August and September are the fourth and first weakest months in the S&P 500 based on data going back to 1957. This is that same data, but now we're looking at the 13 weeks in the third quarter in the S&P 500 based on data, again, from 57. Note that the first 2 weeks of July, which we're in the second week now, are the two strongest of the entire quarter. And we get a gradual slide, weakening seasonality. Seasonality is a tertiary indicator for me, but I still want to know what's going on there, especially if the market's getting vulnerable to having a correction. Note that September includes 3 of the 4 weakest weeks of the quarter. So seasonality outside of the first 2 weeks of July, it's getting a little bit tenuous. Here's large cap. We mentioned this earlier. We've been overweight large cap since May 24th, and we've captured about 1% of outperformance there versus the S&P 1500. That trend is still intact. This is growth style, growth versus value. This is the S&P 500 growth versus value daily since Q4 of last year. We've been overweight growth since May 23rd. It's outperformed value by 14% since then. It's outperformed SPY by about 5 or 6%. So that's where we are. This also shows up in the CART model, which is right here, the CART model. You see it favors growth, and you could see it favors tech over the broad market, favors the broad market over the S&P 500. It favors stocks over bonds, and it favors high beta versus low volatility. So 5 of the 6 domestic relative relationships in CARP retain the previous 6 weeks risk-on environments with 5 offensive and only 1 defensive relative relationship. Indicates investors are overall still confident the stock market can keep rising from here. This is our US versus the world model. All these models look at these relationships in 3 time periods: trading, which is a week; tactical, which we know is 21 days or a month; and strategic, which I mentioned is 63 days or a quarter. The only ones outperforming right now are India, South Korea, and Taiwan. South Korea and Taiwan are directly related to AI. Here's Taiwan. We turned positive, or the model did. It turned positive on April the 29th, started outperforming SPY on a 63-day basis on April the 29th. Since then, it's outperformed SPY by 8%. But again, if we would have been long the NASDAQs in that period, we would have gotten about the same amount of outperformance. I don't like to go overseas unless I have to. And this is more AI than it is money moving out of the US to go elsewhere in the world. Here's our SEAF model. SEAF stands for Sector ETF Asset Flows. I developed a model, my son Jack and I, who works for me and will be the legacy for our business. We developed this years ago when the speed of sector rotation sped up. It used to be sector rotation trends would last a quarter or 2. Now they last 6 or 8 weeks if you're lucky. So we needed to find a way to get into these trades faster and not wait till we could see them on a relative performance chart and get out of them better. So I started experimenting with measuring the velocity of money moving around those 11 sectors, which together are the S&P 500. And the low numbers is the money moving into that sector the fastest in that time frame. So trading, tactical, and strategic technology last week, that was the fastest money moving in. So we got a composite score of 3, 1 + 1 + 1. Second best is financials this week with 2, 5, and 3 to make a score of 10, ranking of 10, I should say. And consumer discretionary is third with a ranking score of 12. We built the model this way. We took a hypothetical $100,000 account and we only invest in the top 3 sectors. If that top 3 changes, then we rebalance weekly on the weekend to reflect the previous day's data. If there's a change, the changes is executed on the opening the next day, and then we're done. All we're doing is following the money around the board. Here's our rainbow charts, which are a part of the CEIF model. You can see this is Technology's CEIF ranking daily going back a year. And here's our favored in green. You can see why I call it a rainbow chart. Favored in green, neutral in yellow, avoid in red. Technology moved into favored status on May 15th, and with just the exception of a couple days at the beginning of June, has stayed there. In the meantime, Technology has outperformed, XLK has outperformed SPY by 5%. Why? Because the money is going there. How do we know? Because SPY or CEIF measures the velocity of money that is going into the various sectors or is also coming out of those sectors. It tells you what to avoid. We don't have time to look at all of those today. Here's financials, which is number 2 this week in terms of ranking. Note that it just moved into favored status on July the 2nd. It's a relatively new idea. We haven't seen any outperformance because it hasn't been there long enough yet. But look here, between November and February of this year, Nova of last year, it got into favored territory, stayed there. Look at the nice outperformance that it was able to get in front of. This is just another chart, part of our CEIF package that shows these rankings in more of a chart format. Through the end of last year, CEIF has outperformed S&P 11 of the past 16 quarters, or 69% of the time. Total return for the S&P from 2020 to 2023, 10.2% versus 25% for CEIF, with about the same standard deviation, 18 versus 19. Much better Sharpe ratio, a 119 Sharpe ratio, which is very good. A beta a little bit less than the S&P, and a maximum drawdown still about 4% less than the S&P. So that's one of our key models. I actually blend CPM and CEIF for my own investing. It gives me a little better performance and even a little bit better money management, a little lower drawdowns. Here's CEIF since 2020 in green versus SPX in blue, and you can see how it's done. This is another chart that looks at them quarter by quarter from 2023. I'll let you look at that on your own. Here's our trading ideas. Our trading ideas, it's another model. It includes industry groups, interest rate ETFs, commodity ETFs, currency ETFs, about 100 ETFs in all. And what we're looking for is positive trend, positive relative performance versus the S&P, positive asset flows, and favorable risk reward. The fourth one is the only one that's subjective. The other ones are just purely quantitative. So over the past 13 months, we've had 46 trades. 74% of them have been winners. Average winning trade is 7.4%. Average loser is only 5.8%. The point here, from a teaching standpoint, is how to set up your ideas. Don't say, well, I saw this on TV today. Establish some reusable priorities. For us, it's got to be in a major uptrend. It's got to be outperforming the S&P 500. Otherwise, why be in it? If it's not outperforming the S&P, buy the S&P. The asset flows have to be expanding to show you that you're not the only guy that likes this. There's new money that's pushing that higher. Asset flow is fuel for these ETFs and for all assets. And then the risk reward has to be right. I'm not going to buy something that's right up against the resistance level and then have to sit through a 6% decline to make 8% on the other side. So quantitatively driven, data-driven approach to investing is how you keep your losses small and you are in the right place at the right time, which sometimes means getting out of the market for a short period of time, going into an ETF that tracks bonds or something else. This is interest rates here. This is the monthly trend or the monthly close in the 10-year going all the way back to 1900. And this is the 10-year weekly going all the way back to 2004. 5% to 523 is the upper boundary. for the yield of the 10-year. 431 to 425 is the lower boundary. If we're testing that now, if we break that, we go back down to 4%. Underneath 4%, you don't have a whole lot going on here until we hit the lower three. So again, I'm kind of giving a cursory talk about rates here, but I covered a lot of territory in an hour. Here's our disclosures and disclaimers from us. And finally, if you like our data-driven approach, would like more information about us, please visit asburyresearch.com and use the contact tab. In the little box, just put 2024 mid-year fidelity webinar, and we'll reply with an email that has further information about our research and services. So with that, I don't know how much time we have left, but I would be happy to field a question or two if there's time, Trey.
Perfect. John, I want to thank you so much. Ton of great information here today. For our audience to take a look at those links that are there, you can download those slides by clicking the download button. Also, if you take a look in that question and answer tool on the right-hand side, I do have that hyperlink available over there for you as well to head over to Asbury Research. You can learn more about what John has to offer there. John, maybe just a real quick question too. We're obviously looking at charts. We're always looking at the past, but thinking about some of the big upcoming future announcements here, how do you factor in a decision-making potential when we look at things like upcoming interest rates? And certainly another topic on a lot of people's mind are the upcoming presidential election. How are you factoring those into your decision-making?
I touched on this earlier. I know financial television is 24/7 and they have to talk about something, and it's usually Powell, or it's usually the election, or it's usually rates. That's a lot of time to fill up during the day. To me, trying to determine how I want to be invested going into November now is three-dimensional chess. First of all, even if I get the election right, even if I get the rates right, that doesn't give me the market. I still have to figure out on a weekly and monthly basis, what do those factors mean for stock prices or industry group prices or sector? It's a three-dimensional game you can't win. I'm strictly data-driven. We are strictly data-driven here at Asbury. And I watch that data. That data tells me what's outperforming, where's the money going, where's the money coming from, what's going on overseas, where are these relative relationships telling us? Is the market confident or is it afraid? And I use that. That's going to give me a lot more dynamic and realistic approach of what all the total wisdom of the market is. Anyone that's got skin in the game, that's the collective wisdom of everyone trading the market. To me, that's all that matters. All this other stuff is water cooler talk and a way to sell stuff on Bloomberg and the other channels. So yeah, strictly again, doing this 40 years. The longer I do this, the more I realize I can't see the future and nobody else can either. So work on models that you can continue to use into the future that are robust and that tell you what the market's thinking, because the market could care less what I'm thinking.
Perfect. Thanks so much, John. With that, we are about 2 minutes past time, so we will go ahead and wrap it up. I want to thank you and our audience so much. Final reminder, head over to asburyresearch.com. If you have any additional questions, John is kind enough to share their contact information here as well. So please reach out to him and his team there. But with that, thanks again, everyone, for joining us. Thanks so much, John. We'll look forward to seeing you at the next one. All right.
Looking forward to it. Have a great summer.
Thank you. Bye-bye.